Worried about index funds? Invest in this instead. So I was watching my man Graham Stephen. I'm going to forget his name one of these days. And then, we talked about the Michael Burry, whatever that guy's name is, from I think it's from The Big Short or something like that. I forgot what that movie was, where he created, was it Michael Burry? One of those guys who bet against the housing market and whatnot. And Michael Burry is saying index funds are going to lead to chaos, total chaos, mass confusion, rhymes so hypnotizing they might cause an illusion. You know what that's from? Anyway, so Michael Burry is worried about the index funds being a bubble. All right, so if you're worried about this, what do you do? What do you do? Well, you got to stay tuned, I'm going to tell you. Because first we're going to just elaborate again, as I've done before, about why they're worried. Now, Graham wasn't actually. It was interesting. Graham wasn't. I just, watching his video made me think about another portion of this argument that I wanted to talk about. So Michael Burry et al. Are worried that there's too much money going into index funds, and thus the price mechanism has been distorted, if it exists at all, because all these people throwing money in, essentially, that's not based on value or fundamentals or research or anything like that. That doesn't concern me in the least. But the issue is, if everyone's putting all their money in, and it's just going blindly, regardless of profitability, regardless of price earnings ratio, wouldn't that be a PE nightmare in terms of valuations and stuff? And no, it's not, but be it as it may. And then his thing was, if everyone just sells in mass, which is silly, but if everyone just did, there'd be, like Graham was using the analogy, it'd be like a movie theater that's taking more and more and more people into the theater, but the exits are still the same. So you got this huge amount of supply, or demand, huge demand, and the supply at that point will be smaller and smaller and smaller, thus knocking up the prices. And if you needed to get out, you're not going to have any demand for the stocks that you're trying to sell. So it's the exact opposite of what happened in 2008. Not with stocks, but with certainly bonds, because of mark-to-market accounting, there's no demand. A huge supply side, no demand on the sell side. On the buy side, huge growing sell side because of regulations of mark-to-market, and demand was just not there. I mean, no one's going to buy a bond because they're trying to sell their own. And that was what led to the chaos of 2008. And that's what Michael Burry is basing his thing on, the index funds. You have this huge demand, in a limited supply, thus is creating these nosebleed prices on stocks. And then what happens when you have this huge supply, i.e. the sales side is going through the roof and there's no demand to buy the stocks, and then you're going to have a plummeting of untold proportions, similar to what we saw in 2008. Okay, let's just presume that's the case. I mean, if that were, how do you avoid that? Because the premise would be, well, I don't want to buy the S&P 500 because it's cap weighted, and so the biggest stocks are the largest constituents of the S&P 500. And as I said before, the S&P 500 is an actively managed index. What I mean by that, there is a committee at Standard & Poor's. I don't know who's on the committee. I'm sure it's easy to find out. I don't care. But there's a committee of people who say, we're going to add this and we're going to get rid of that. I think they meet 4 times a year, and what they change it, 10 holdings a year or something like that. Not much, but it's still actively managed, and it's based on market capitalization. So the higher the market cap, the bigger proportion of the S&P 500 those stocks represent. So I think Graham was saying 10 stocks in the S&P 500 represent, I don't know, some enormous amount of the totality of the portfolio. All right. So if those 10 stocks suddenly have to be sold in mass, the small cap stocks, which are not being, no one's buying small cap stocks, they're all buying more and more percentage of the 10 largest stocks. So if they had to be sold in mass, those 10 stocks have more room to fall, and everybody will get hurt. There's actually a band called Everybody Gets Hurt, by the way, out of New York City. They're great. So if you like your music loud and boisterous, Everybody Gets Hurt is a good band. All right. So what should you do instead? Well, there's something called research affiliates, and they have smart beta, equal share indexing. I think research affiliate is a guy named Rob Arnott. It's just a freaking great source of information on investing. I'm a huge fan of research affiliates. Have been for a long time. Rob Arnott, the guys over there and ladies, they're just freaking, just fantastic. And Ed Easterling, he's not with East Research Affiliates, but I think he just died actually. Probable Outcomes, lots of, Crestmont Research is just Crestmont Research. All these guys are fantastic. But Research Affiliates, I think they came up with the equal weighted index, and DFA, Dimensional Fund Advisors, has their own equal weighted index as well. So if you're concerned about the bubble of index funds because more and more money is being thrown to the largest and largest and largest stocks, well, you just buy an equal weighted index fund. I mean, there's still index. Just because it says index fund on the name doesn't mean it has to be cap weighted. We have equal weighted index funds, and those can be more. So what an equal weighted index fund simply says is every position. Let's see, if you have 500, we'll just use 500 stocks. Each position represents, divided into 100%. I don't know, what's that? Is that 2/10 of 1% or something like that? I guess it'd be 2/10 of 1%, right? So yeah, 20%. 1/5 of 1%, right? And that'd be so. Each stock in the index is valued at 1/5 of 1% across the board. So Amazon and freaking Heritage Wealth Planning are all worth 1/5 of 1%. That's an equal weighted index. It's still an index. So the word index, to say index inherently means bubble, it's just silly. There's index. There's freaking leverage index. There's short indexes. There's all kinds of index funds, so don't get caught up in this idea the index is in of itself a bubble. That doesn't make any sense. That'd be like saying the stock market is in a bubble. Well, there may be some stocks in a bubble, but not all stocks are in a bubble. You look at financials, they're trading at PE ratios around 10. Is that a bubble? No. So you can't throw the baby out with the bathwater. So if you are concerned about the high valuations of the constituents of the S&P 500, representing a bigger and bigger pull of the S&P 500, and thus if those stocks get hammered for whatever reason, well, you can still buy an index fund, just make it an equal weighted index. Look up Research Affiliates, man. It's just a great research place, shop. I'm a huge fan. Listen to any Rob Arnott podcast. Just a huge fan. And going back to my man Meb talks about this all the time, about momentum and trends. And the interesting thing about the S&P 500, the reason it outperforms is literally a momentum play. Now, the reason it has so much volatility is because it's literally a momentum play. And just like, the freaking Atlanta Falcons up 28-3 with 3 minutes left in the third quarter of the Super Bowl, all the momentum was on their side until it changes. We don't know what causes things to change. We don't know what causes all of a sudden in 1929 and 1973 and all these things to just magically the momentum shift from bull to bear. We don't know. And you'll never know in advance. You just don't know. So what does all that mean? You can still buy index funds and not worry about the Michael Burrys or whoever else is out there spouting about the frothy valuations of the largest constituents of the S&P 500. Again, I think Graham said 10 stocks represented, I can't remember, it was a significant proportion of the S&P 500. And I actually agree with that. I'm a big fan of equal weighted index. Equal weighted just means, again, we already talked about it, equal share according to each stock that's in there. And what that means is more small cap stocks and more value oriented stocks will have a bigger proportion relative to the S&P 500 index. And because of that, it'll be more risky because value in small stocks are inherently riskier for sure, because there might be a reason they're small cap. There might be a reason they're valued. But value stocks definitely are riskier. That's why they're valued, because the price has been knocked down for whatever reason. So anyway, at the end of the day, though, if you want to buy in an index and you want to spread your risk among many different stocks as opposed to just one larger and growing constituency in the S&P 500, the equal weighted index is the way to go. I hope this helps. Don't forget to subscribe. Thumbs up always helps, and we'll see you next time.